Welcome to WealthWise with me, your host, Jordan Kimmel. And later on in the show, we're going to have a great guest. He's the Senior Economist at Interactive Broker. It's José Torres, looking in from the outside, looking in from the bottom up, really getting some read on what's going on with the economy, how it relates to the market. And so before we bring Jose on, I want to always spend, like I do, just 2-3 minutes bringing you up, number one, on the market, number two, on developments here. So we at WealthWise, with our, we'll call it our sister newsletter, launch this week. Pro Investors Insight is out, proinvestors.co. .co if you want to go and sign up or even get a read of the newsletter that just came out. What we're doing in the newsletter is, rather than me telling you what I think all the time, we're taking the same approach as we do with this show, allowing the experts from the fields, different asset classes, the bond market, the economists, the stock market, commodities as well, and sharing their insights and what they see. So Pro Investor Insights has already recruited some of the biggest names in the industry, including Forbes, including a dear friend, Louis Navellier, including the American Association of Individual Investors, and the list goes on and on. So our goal is a one-shop spot where once a month, you can get all kinds of views from really some of the most renowned investors that are walking and have lived on Wall Street for the last couple decades. And really proud of the inaugural issue. And we're really suggesting get your hands on it, tell some friends. And, one of the things that we decided to do, because our basis is on education and the basis is of service, is to actually make this newsletter complimentary to all schools, all students, members of the military, as well as veterans. So if any of our listeners are close with any of their schools, any groups within the military, veterans groups, let them know this is 100% complimentary. We're not giving them a deal for the year. We're giving them complimentary exposure, because we think really financial literacy is one of the things that's missing in this country. Trading on moving averages and trading on the last news clip just frankly isn't good enough. So that's Pro Investors Insight and proinvestors.co. And what I'll share is I'm even going one step further with CrossCheck Media. We're putting out a weekly piece because the market's moving, really quickly. And I'm just going to say, you go to our site, you go to Substack and find us. And we're putting out not only a monthly, but a weekly. And I'm telling you, the market's almost like the weather right now. It changes like San Francisco weather. It changes 5 times in the day. If you really want to know what I'm thinking and you really know what I'm feeling, go check the last few weeks out and check out our newsletter. And we'll take a real quick break. We're going to bring José Torres from Interactive Broker. He's their senior economist, and I can't wait to hear what he's got to say. We'll be right back from a real quick break. Stay tuned for more MarketWise in just a minute.
There's a lot of sameness among online brokers these days. IBKR stands out in the crowd. We offer the lowest trading and borrowing costs. Our clients have the choice of investing globally or locally in stocks, options, futures, forex, bonds, and funds from a single integrated account. Our premier technology enables you to optimize speed and efficiency, perform sophisticated portfolio analysis, and manage your accounts. Start investing today at IBKR.com.
And welcome back to WealthWise with me, your host, Jordan Kimmel. We have a special guest on today. It's José Torres, Senior Economist at Interactive Brokers. And first of all, Jose, thanks so much for joining us.
My pleasure. Great to be here, Jordan. Hello, everyone.
All righty. Well, it's great to have you, Jose. You know, we cover every bit of the capital markets at WealthWise, the stock market, the bond market, commodities, and so on. I've been in the industry for decades already. I can't remember, Jose, a year where every segment leads with what's the Fed going to do. You're in center stage right now. We're on recession watch. People talk more about the economy than stock market itself. But why don't you take a minute, give a little bit of your background, how long have you been interactive, and then we'll get into the special kind of clues that you look for that maybe others don't.
Sure. So I've been an economist for almost a decade, roughly 3 years at BLS, the Bureau of Labor Statistics, as an economist, and then as an economist again at the FDIC, the Federal Deposit Insurance Corporation. And I've been here, senior economist at Interactive Brokers, almost 3 years in December. My specialties are pretty broad. I like to cover the economy as well as equities, rates, options, yields, really have broad coverage, cover regional economics in the US, also cover international economics, and participate in podcasts like this, television programs, written commentaries all the time.
Great. Well, that's pretty broad. And I've seen some of your interviews, I've read some of your pieces, tremendous experience. And I think what's really important, what I'd like to kind of start with is, especially with your background, people kind of confuse the market itself and the economy and that they run in pure parallel. But often the markets are going to run ahead of economic news, positive or negative. Share with me, number one, if you agree with that sentiment and how people can, kind of get more lockstep into the market, understanding the economic side.
Well, Jordan, we are in a market that's the most disconnected from actual economics in a long time. And really, the COVID-19 pandemic shifted the economy and markets in a way that we haven't seen in a long time, similar to what we saw post the financial crisis in 2008. And then we had a big shift in the dot-com crisis back in the 1980s. We had, big shifts with from the transition from Carter to Reagan, then to President Bush, then Bill Clinton. We had a lot of different transitions. Now here, we are in a rally after the Fed hiked 525 basis points.
Not that common.
Not that common. Concentrated rally, right? We have the rate-sensitive growth areas of the market piloting the bulls forward. Value investing, which I sort of grew up understanding investing in the markets through a value kind of lens, sort of, if I buy a company, I'll get my money back theoretically on the forward PE over a certain amount of years, right? So a PE of 10, theoretically, I'll get my money back if earnings grow in 7 or 8 years, right? I grew up thinking about investing in that way. But the last 10 or 15 years, Jordan, right, being a value investor hasn't been particularly beneficial, right? It's been all about growth. It's been all about tech. First, it was a lot of shifting themes, right? Bitcoin and crypto was going to be the best thing ever, Jordan. But guess what? It's 2024. We're still below the highs of 2021. Electric vehicles were going to be the best thing ever. Now, maybe not so much. And now, Jordan, we're in the middle of the artificial intelligence wave in a capital expenditure boom that, quite frankly, I'll tell you, I think it's unreasonable. And I think folks are forgetting the boom and bust cycles that semiconductors have always sort of the course that semiconductors have run since, the 1970s, 1980s. My family's from Cuba, left communist Cuba. And we in the 80s, they talked about AMD and Castro and Reagan and the Soviet Union and all that kind of stuff. And the stock would go from $50 to $10. Right. Yeah. And I'm afraid, final point here, I'm afraid that we're really, really putting all our eggs in one basket here with the whole AI trade.
Well, Jose, and again, I've been around even longer. I might be a little bit older than you. I remember more cycles. And the thing is that people do forget it's a great point that semiconductors it's a growth industry, but it's cyclical. And people forget maybe that NVIDIA was down around 75% in the year 2022. That wasn't that long ago. And people began tripping over each other. And to your point, I bring it up all the time. The build out on the internet itself, which turned out to be bigger than people thought, was wrought with companies that went bankrupt, building out the infrastructure, JDSU, Uniphase, and Global Crossing. These companies don't even exist anymore, and they were considered the leaders of the backbone. So, your point is super well taken. And let me go one step further because I have an economics degree myself. I like to say I put it in the drawer because sometimes it's not linear and what you think should happen doesn't happen. Let me go back to something you mentioned about COVID. What textbook, Jose, did we read that talked about negative 2% interest rates and how people were piling into European bonds with negative 2% yields? And then the mess they got into just a couple of years later.
Look, I mean, governments have become control freaks in the 21st century, right? And unfortunately, that distorts markets. It distorts economics. Real quick, I did a podcast 3 weeks ago with former FDIC Chairman Bill Isaac. He was instrumental in shaping Reaganomics. I think for those that want to hear more about the lessons of the 1980s, you can go see that. But while we're here, there's been significant problems with unleashing liquidity, dropping rates, increasing central bank balance sheets, and how that actually filters through the entire economy. And unfortunately, what we're seeing today here in the United States is we have a bifurcated consumer. We have, on the one hand, we have the consumers in Greenwich, Connecticut, Martha's Vineyard, Boca Raton, Florida, where I am today, Silicon Valley, who are doing great. They own multiple houses, they have investment accounts, the market's going up, right? But then you have the other consumer, right? The consumer in Louisville, Kentucky, the consumer in Cleveland, Ohio, the consumer in Austin, Texas, right? And they're seeing their wages grow 4% year over year. They're seeing price level, which is significantly higher than they're used to. They're going to Whole Foods and Walmart and Target, and they see that a bag of bananas, Jordan, costs $50, right? And for them, they don't own stocks, they don't have homes, they're renters. In fact, the housing affordability dynamic has been terrible. Today is July 23rd. We just got existing home sales this morning at 10 a.m. amongst the worst levels we've seen back to the 2008 financial crisis, right? And that's really hampering the American dream and the reason for Americans to save, which for a long time, the whole reason to have a nest egg was to make that first down payment and then build some equity in an American house.
That's how I grew up, and that's the way it was. And you touched on something that's super important. And again, when you understand business and business cycles, you realize that it's called a cycle. There's expansion and there's contraction. And this word recession has become such a dirty word to, I guess, Washington, that they want to avoid it. They want to pretend we've conquered the business cycle, and it's always 2%, 3% straight up. And if you will, that actually delays the problems until they're insurmountable, and then we get crashes. And so maybe we just, talk about maybe the psychology of what it is. Maybe the administration doesn't want to have a recession on their hands. They kick the can down the road. They issue more and more bonds. They issue more and more debt. There's a growing feeling, Jose, that this is really not sustainable, that occasional brush fire is okay. You don't want to have the whole mountain on fire.
Well, Jordan, back to the control freak comment. Governments they hate recessions. They want to quell volatility by adding liquidity every single time. It's terrible. Recessions, the business cycle, these are beautiful things. They're natural things. When you have a recession, when you have a weak point, those businesses that were poorly managed, what happens? The shareholders lose, the managers have to find new jobs, they have to get their act together. Now, Jordan, if we don't have that recession, right? If we don't have that volatility, what happens to these managers? They can continue existing. They can continue getting away with murder. They can do whatever they want, really. And that's no good for the economy. For the 16-year-olds, right? That's in Atlanta, Georgia, that's thinking about growing their career by doing the right thing. What kind of examples are we setting if in 2023, last March, when Silicon Valley, Signature Bank, First Republic, and New York Community had those issues, right? We just come in and we just help them every single time. Final point here, in the second half of 2022, a lot of us, we got excited. We kind of grew up with sort of like the Austrian School of Economics, Milton Friedman, that sort of thing. And when Powell would come out and he would talk about Volcker and the sacrifices required to get to 2% inflation, we were loving it. We were saying, wow, you know, we're really going to go on a course. We're going to unleash 20 or 30 years of economic growth because of Powell, similar to what Reagan, Volcker, and Isaac did in the 1980s, right? And we're going to have a good 20, 30 years. It's going to be morning in America again. Folks are going to dream. Their dreams are going to come true. It's going to be great. Instead, as soon as there was a hiccup, as soon as there was some turbulence, we come out, we boost the balance sheet by $300 billion. The market went up 24% year to date, last year rather, full year for S&P 500. This year, yeah, we're down 2% from the highs. We're still up 16%. Year to date, it's only July. Every dip is getting bought, and it's just this economy. It's just not broad based. It doesn't work for everyone. It doesn't really. It's not the best we can do. We're becoming Europe, and Europe has been growing slowly and having a lot of problems over the long term. Let me just end it there to not go on for another hour.
Well, no, you're hitting really the points that, an economist would, loves. And the fact is, what people forget is the bond market is kind of the tail that wags the dog. And the bond market, is gigantic. And while I myself love equities, the big money is in the bond market, and it's the return of their money. So let me just bring up like 2 points here, kind of bring this home a little bit. We're talking about how crazy high the interest rates are. I got into business. I was selling muni bonds at 9%, and government bonds were up around 11.5%. Okay, that's really high rates. What I think that we're in a period where, as an investor, you hope to get 5% in the bond market. You're able to get it. That 0% is not normal. That's not the normal thing. So maybe 8 or 9% in the stock market. And if you think you have an edge, like we think we have a model that presents an edge, maybe you could do teens or mid-teens if you're lucky. But this idea that interest rates need to be zero again, I mean, please throw some cold water on some people that are asking for 0%, Jose.
Jordan, we are living in a different world post-COVID. 2 main factors why inflation is structurally higher. The shift from globalization to regionalization, i.e. Mexico today is our top importer, no longer China. We love it. It's more reliable. We're closer to them, but they're much more expensive.
Right.
2, deficit financing, right? That's going to support inflation. I mean, we're running these crazy deficits in an expansion with the unemployment rate at 4%. It seems like political suicide for anyone to go in and start talking about austerity. We seem like we're going more on the path of Japan, where pretty much at some point, QT is going to have to stop and the Fed's just going to have to own all the bonds. And our society is just going to be sort of pulseless, right? Because we destroyed the cycle. We destroyed volatility. We're no longer going to have recession, but we will become, Jordan, pulseless. The doctor will come, we'll check our pulse, it'll be 0. I don't think
I don't want to live in that world, Jose. I don't want to live in that world. So let me kind of ask you this, real important. So you and I know that cycles are unavoidable. There's going to be a slowdown. Um, Certain people look at this, certain people look at that. I'm going to admit I'm not good looking around corners. Is there any statistic, is there any number that you follow that you think is kind of underfollowed that people should keep their eye on, that may give them a clue that, okay, slowdown is here? What statistics do you look at, if any, that are off the main menu for the Fed right now?
Yeah, so that's I look at a lot of them right now. Let me tell you what's maybe some of the most bearish ones, right? Some of the most that are pointing to pretty much a downturn, right? So if you look at the FHA borrowers, mortgage delinquency rates, and that's pretty much going to tell you folks that didn't have a 20% down payment. Most of them had a 3 to 5 or 10% down payment amongst the lower credit scores, and that's going to tell you the story about the lower end consumer. Those delinquency rates are through the roof. They're higher than the 2008 financial crisis, right? So
really,
yes,
not heard that anywhere. Okay.
Well, I'm glad. Wow, I was hoping you wouldn't say, well, yeah, we heard that 10 times yesterday. So
no, I'm saying people aren't saying that. People are not bringing this up.
Consumer confidence and sentiment, right? How do consumers feel? They do feel bad. They're upset because elevated rates, tall prices, reduced credit availability. They're not able to do the things that they'd like to do. Look at the manufacturing and real estate sectors combined. They've been in contraction for such a long time. So ISM manufacturing and existing home sales, right? Those things have been in contraction for so long. It's roughly 30% of the economy combined, manufacturing and real estate. And historically, the weakness in those two areas starts to spread everywhere else. But we're not seeing it as much this cycle because, folks aren't really buying homes as much. They're spending all their money on services. They don't have an incentive to save. So they're just spending on services. And that's also limiting the downside from manufacturing. So what's going on with services spending? Services spending, Jordan, today is like a light switch. Consumers, this month, it's July. They spent like crazy, theoretically. Next month is August. They're going to take it easy. Whoa. Let's chill. No movies. We're going to eat microwave food, a banquet meal, and then in September, we're going to go back. Now, that's sort of what consumer spending has been like. And we can point to ISM services and retail sales. It's been very erratic. It's not stable. Personal savings rate, also really low.
Right.
Yeah, and there's a few others that I'll remember.
You touched on them. You've touched on them. So let me kind of wrap this up, Jose. I love the conversation for one important reason. Harry Truman said he only wants a one-arm economist, right? Because on one hand and on the other hand, and you're one of the refreshing economists will actually not do one hand and the other hand. You spoke it like you see it. And and I really appreciate that. And nobody knows the future, but we know history and we know trends. And it seems like a lot of the public right now, their memory banks go back at least 2 days, but not much past that. And what I'm hoping to do, Jose, is I do believe economics drives the markets. I believe that you have to understand the interrelationship with the economy and the markets. And we hope to have you back on periodically. And I want you also, if there's anything you see, any flash statistic that really stands out to you, get in touch with us, please, on your own. And we'll have you right on to discuss that. But I really appreciate the time. I'm going to tell everyone here, full disclosure, our accounts at Interactive Broker, they have some of the best technology, some of the smartest people. And Jose Torres, Senior Economist, you're one of them. Thanks so much for joining us.
It's a pleasure to be here, Jordan. Thank you, and I look forward to next time.
Absolutely. So let's sign off here. Jordan Kimmel, your host on WealthWise. Home St. Torres, thanks once again for joining us. We'll see you soon for sure. Bye-bye.